Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex language of corporate filings to uncover the real story behind the numbers. And let me tell you, today's filing is a real page turner. It's about a company doing a bit of financial alchemy, turning debt into shares, and boy do we have some thoughts on that. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below if you want to chat all things finance with us. Impact BioMedical Inc. just dropped a report detailing a rather interesting deal. They've essentially swapped a bunch of debt for ownership in their own company. Think of it like this. They owed someone money, and instead of paying it back with cash, they're giving them a piece of the company, their stock. This filing is all about a debt conversion agreement. Essentially, Impact BioMedical owed DSS Inc. a pretty penny based on a loan that's been around since March of 2023. This loan was originally for a hefty $12 million, and it's gone through a few changes. Back in January of last year, they adjusted the due date, removed the ability to borrow more, set out how they'd pay it back, and even changed the interest rate to be tied to the market, specifically the WSJ prime rate plus 0.5%. Now, the big news from July 21st, 2025 is that they've settled this debt. How? By handing over a massive chunk of their own stock. We're talking about 31,778 shares of freely tradable common stock. This isn't just paying back the loan, it also covers any other financial or operational support DSS provided between June 21st, 2025 and when this deal was finalized. It really puts a cap on their obligations to DSS for this particular loan and related support. So what does this actually mean? When a company converts debt to equity, it's a way to clean up the balance sheet without spending actual cash. For DSS, the lender, they're exchanging their right to be repaid with interest for actual ownership in Impact BioMedical. This can be a good thing for DSS if they believe the company's stock will go up, as they'll profit from that rise. For Impact BioMedical, however, it means more of their stock is now out in the market, owned by a new group of shareholders, and their total number of shares outstanding has increased, which can dilute the value of existing shares. This kind of move suggests the company might be facing cash flow challenges or is prioritizing its cash for other operational needs. By issuing shares instead of cash, they're preserving their liquid assets. However, it also signals a potential lack of confidence in their ability to generate enough cash to cover their debt obligations through more traditional means in the near future. It's a strategic maneuver that can prevent immediate default but comes with the long-term cost of diluting ownership for. It's a strategic maneuver that can prevent immediate default but comes with the long-term cost of diluting ownership for existing shareholders. We don't have detailed financial tables in this particular filing that show year-over-year changes or current financial health in a breakdown format, but the narrative here is clear. The company is settling a significant debt by issuing a large amount of stock. This is a crucial event for Impact BioMedical as it fundamentally alters its capital structure and ownership landscape. Now, looking at this deal more broadly, Impact BioMedical is essentially betting on future growth to make this share issuance worthwhile for everyone involved. If the company's value skyrockets, DSS will benefit from their new ownership stake, and Impact BioMedical will have deleveraged its balance sheet, albeit with more shares outstanding. However, if the company struggles, DSS might find themselves holding stock that's worth less than the debt they forgave. A key risk here is if this issuance was the only option available to the company, indicating potential underlying financial distress. Investors will be watching closely to see how these newly issued shares impact the stock's performance, and if the company can indeed grow into its new capital structure. The fact that the shares are freely tradable means DSS can sell them on the open market whenever they choose, which could put downward pressure on the stock price if they decide to exit their new position. In conclusion, Impact BioMedical's decision to convert a significant debt to equity is a bold move. It addresses an immediate financial obligation but introduces new dynamics regarding share dilution and ownership. We'll need to see future reports to understand the full impact of this transaction on their financial health and stock performance. Alright, that's our breakdown of Impact BioMedical's latest filing. What's your take on this debt for equity swap? Do you think it's a smart move or a sign of trouble? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out and tells us you want more of this content. And of course, subscribe for more deep dives. Don't forget to check out our Discord in the description to join the conversation. Thanks for watching. See you next time.